Have you ever stopped to think about what money truly is? It's more than just paper and coins, it's a system of trust and value. But how does it all work? When we delve into the mystery of money, we find that it's a fascinating construct that holds our society together. It's not just about the physical notes and coins in your pocket. Money, in its essence, serves three primary functions: a medium of exchange, a store of value, and a unit of account. As a medium of exchange, money facilitates transactions. It's a bridge that allows us to trade goods and services with one another without resorting to barter. Imagine if you had to trade your car for a house or your shoes for a cup of coffee. Money simplifies this process, making trade more efficient and straightforward. Then money acts as a store of value. It's a way to squirrel away wealth for the future. You can save your money today and spend it tomorrow, next week, or even years later. Of course, this function depends on money retaining its value, which brings us to the concept of inflation. But we'll delve deeper into that in the upcoming scenes. Lastly, money serves as a unit of account. It's a measure we use to compare the value of different things. Just like we measure distance in miles or kilometers, we measure economic value in terms of money. This function allows us to understand the relative worth of various goods and services in the marketplace. But here's the catch: money only works because we believe in it. We trust that the piece of paper or metal coin we hold has value, and that others will accept it as payment. This trust is the linchpin that holds the entire system together. It's what makes money, well, money. So in essence, money is an intricate system of trust and value, woven together through a complex web of transactions and beliefs. Unraveling this mystery gives us an insight into the very fabric of our society and economy. Understanding money is the first step in grasping the financial system. The financial system is like a giant web, connecting various entities and facilitating the flow of money. But what are the key components, and how do they interact? Let's start with the banks. These institutions are like the heart of the financial system, pumping money around the economy. They take in deposits from savers, and then lend out this money to businesses and individuals who need it. In doing so, they help ensure that money is always circulating and that the economy keeps moving forward. Next, let's turn to financial markets. These are the arenas where securities like stocks and bonds are bought and sold. They play a critical role in determining the prices of these securities, which in turn affect the cost of borrowing and the return on savings. These markets are the nervous system of our financial body, communicating information and transmitting signals throughout the economy. And then, there's the government. It's like the brain of the system, making key decisions and setting the rules of the game. The government regulates banks and financial markets to ensure they operate fairly and efficiently. It also uses monetary and fiscal policies to manage the economy, adjusting interest rates and government spending to keep inflation in check and promote economic growth. But all these components don't function in isolation. They interact in complex ways. Banks rely on financial markets to raise funds and manage risks. Financial markets depend on banks for liquidity and financial services. And both banks and markets are shaped by government policies. In a healthy financial system, these interactions are smooth and efficient. But when something goes wrong, say a bank fails or a financial market crashes, the effects can ripple through the entire system, causing economic turmoil. Understanding these intricacies is like learning a new language. It takes time and patience. But the reward is a deeper comprehension of the forces shaping our economic lives. The financial system is a complex, interconnected network, but by breaking it down, we can begin to understand its workings. Inflation, a word we often hear, but do we truly understand what it means, and how does it affect us? Let's start by defining inflation. At its core, inflation is the general increase in prices and fall in the purchasing value of money. Sounds simple, right? But the implications are far-reaching. Think of it this way. If last year, you could buy a loaf of bread for $1, but this year that same loaf costs $1.10, that's inflation in action. Your dollar doesn't stretch as far as it once did. But how do we measure inflation? Well, we have a few tools at our disposal. One of the most common is the Consumer Price Index, or CPI. This index tracks the price of a basket of goods and services over time. If the price of this basket increases, we say that inflation has occurred. Now you might think, so what, things get more expensive, big deal. But the impact of inflation is more profound than just a pricier loaf of bread. For starters, inflation erodes the value of money. This means that the cash you have today is worth less tomorrow. This can be particularly damaging for savers as the value of their savings diminishes over time. Moreover, inflation can create uncertainty in the economy. If prices are constantly rising, businesses may hesitate to make long-term investments. This can stifle economic growth and lead to job losses. But it's not all doom and gloom. A moderate amount of inflation is actually good for the economy. It encourages spending and investment, which can stimulate economic growth. So, while inflation might seem like a phantom, constantly changing and hard to pin down, it's an essential part of our financial system. It affects everything from the price of your morning coffee to the state of the national economy. Inflation may seem like a phantom, but its effects are very real and tangible. Interest rates, they're the cost of borrowing money, but their influence extends far beyond just your bank account. Let's dive in. Imagine you're a borrower in a world where interest rates are the gatekeepers. These rates determine how much it'll cost you to borrow money, and they're set by central banks like the Federal Reserve in the United States or the European Central Bank in Europe. But here's where it gets interesting. The central banks don't just pick a number out of a hat. They base these rates on economic indicators like inflation and employment levels. Now let's look at how these interest rates can impact you and the economy at large. Firstly, let's talk about savings. When interest rates are high, your savings grow faster because the bank pays you more for keeping your money with them. It's like planting a seed and watching it grow into a money tree. But when rates are low, the growth of your savings slows down, much like a tree in winter. Next, let's discuss loans. High interest rates make borrowing money more expensive. It's like a steep hill you have to climb to get to your dream house or car. But when rates are low, it's more like a gentle slope, making it easier for people and businesses to borrow and invest. Now, onto investments. In a world of high interest rates, bonds become more attractive. Why? Because they offer fixed returns that are now more competitive compared to other investments. But in a low-interest environment, people are more likely to invest in stocks or real estate, where they might get a higher return. So you see, interest rates are like the heartbeat of the financial system, setting the rhythm for various economic activities. They determine how much you earn on your savings, how much you pay on your loans, and where you might want to invest your money. Interest rates wield a lot of power in the financial system, affecting everything from your personal finances to the global economy. We've unraveled some of the secrets of the financial system today, but this is just the tip of the iceberg. From the enigma of money, we've journeyed to the heart of the financial system, tussled with the phantom of inflation, and discovered the potent force of interest rates. Let's take a moment to reflect on our adventure through this intricate maze that governs our economic lives. We started with money, that simple yet complex medium of exchange. It's not just paper and coins, it's a promise, a store of value, and a measure of wealth. It's a social construct that we all collectively agree upon, and it's this agreement that gives money its value. We then dived into the financial system, that vast network of institutions, markets, and instruments. It's like the circulatory system of our economy, moving money from where it's in surplus to where it's most needed. Banks, stock exchanges, bonds, insurance companies, they all play a vital role in keeping the system running smoothly. Next, we confronted inflation, that seemingly ghostly phenomenon that erodes the purchasing power of our money. It's like a silent thief, slowly but surely eating away at the value of our hard-earned cash. But remember, a little inflation isn't necessarily a bad thing. It's when it gets out of control that we have to worry. Finally, we delved into the world of interest rates. Those powerful levers that can stimulate growth or rein in an overheating economy. They affect everything from the cost of borrowing to the return on investments. Understanding how they work can give you a leg up in the world of finance. So there you have it, a whirlwind tour of the financial system. But remember, this is just the beginning. There's so much more to learn, so many more secrets to uncover. If you found this video helpful, don't forget to hit the like button and subscribe for more insightful content. Remember, knowledge is power, especially when it comes to understanding the financial system.